Hello and welcome to episode 328 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Links. Damien, welcome back. How are you doing?
Well, I'm good. Last week, I have to let people into the sort of behind the curtain on the podcast, because at the start of last week's podcast, I mentioned the football, didn't I? And then Andy panicked on the Sunday, because there was a potential for the podcast to go out with me saying it's coming home, and we'd actually lost against Ukraine. But fortunately,
we're letting people behind the curtains on the record. We did record before the Ukraine game, and I sent you an expletive message on the Saturday saying you do realise that we're in danger here of having to re-edit this or putting something out that is immediately out of date.
Yeah, and Andy created a second version that didn't have me talking about the football. But the reason I'm doing it this week is because the game's not till later on, so we don't really care, because by the time most people listen to this, the final hasn't actually even happened. So anyway, we won't talk too much about the football because we've got so much to do this week. We've got a bit of a treat for people on the podcast. There are going to be more than just Andy's voice and my voice this week. There are going to be 4 people on the podcast, because Bronte's back on the podcast, and so is
Can we
Laura.
say by popular demand? Or
We can say by popular demand, if you like, especially as she is sitting in the room as we record this part of the podcast. So by popular demand, Bronte, you are back on the podcast. So the 3 pieces I'm going to do this week, there's one on financial jargon. I've been asked by a number of people to explain some of the terms that I use in midweek markets. So this isn't going to be a complete list. This is some of the ones I've been asked about. If people want me to do more of them in the future, then do send them in, because it can be a regular part of the podcast if we want it to be, because it helps people learn about finance and get them into investing. The second piece we're going to do on the podcast is going to be about mortgages, but more importantly, how much you can borrow. So we're going to be looking at how mortgage lenders assess affordability, but also multiples, and that will be Laura doing that piece. And finally, we'll come on to Bronte, who'll be doing a piece regarding insurance, and if you are doing any work or renovation on your house, because there's an unfortunate tale this week that we saw somebody whose house had caught fire while having work done on their house. So it spurred a conversation in our office about whether people knew about what you should be doing and telling your insurer if you're doing work to your house. And most people in the office didn't know you have to speak to your insurer about certain things. So we're going to do a piece on when and when you don't have to talk to your insurance company.
Okay, so let's start off with the investing piece then. And we're talking about investing jargon. And this is on the back of people getting in contact and say, look, I love midweek markets. It's great. I get a lot of insight. But actually, there's a few things I don't quite understand. Could you explain them?
Yeah, and what's interesting is Bronte picked this up, and we've been talking about it in the office about developing a glossary of some kind at some point on the site. So we're looking at what the best way to do that is. And for now, we're going to do a quick piece on the podcast about some of those terms. So I'm going to rattle through them because I've got a number of them I want to cover. So the first one I was asked about is growth stock. So you'll hear me sometimes talk about growth stocks, and they are typically from sectors like technology companies. And a growth stock is a share or company that grows at a rate that's significantly above the rest of the market. And the way they do that is they usually reinvest all of the money that they make into trying to grow the company. So they don't typically pay dividends. So for people who buy them, they're basically buying them for the long term, the fact that the price of the share is going to go up, and therefore that's how they make money. An easy way to think about it is to have an example. So somebody like Facebook is a good example of a growth stock. You think about the money that they make and the profitability. They make more and more money, and the amount of money they make grows incredibly over time. So that's a growth stock. On the flip side, there are value stocks. So what's a value stock? Now, that is a share in a company that's trading below the fundamental value of it. So how do you assess the fundamental value of a company? That can be by looking at its accounts. There are ratios like price to earnings. So you take the price of the share and you compare it to the earnings that the company generates. So that gives you a measure of how much you're paying for something. If the price is high and the earnings are quite low, then you can see that ratio of price to earnings will be very skewed. So it makes it expensive. So the higher the PE number, that's what they call it, the more expensive the company is. So you have historical averages. You can compare them to other companies within their sectors. So that's where you get value. And so if you assess value, therefore you look at the fundamentals, you could get to a case where you think a company is undervalued. So the rest of the market doesn't think it's worth buying, but you do, and you think it's cheap based on whatever metrics that you use, and therefore you will buy that stock. So that's why it's called a value stock, because you see value in it, on the hope that the market then sees that value at some point and the share price rallies higher and hopefully explodes higher. So there won't be a given type of company that will be a value stock. It is very dependent on looking at the individual company itself.
Can I ask a really quick question on that? Can a type of stock move from being a value stock to being a growth stock?
In theory, it can. I mean, you don't see it all that often because the value part is to do with a metric based on fundamentals. So the price of the stock could catch up with fundamentals, if that makes sense. So actually people start buying it. But a growth stock is really detailing how that company works and how its earnings are made and how it distributes them to shareholders. So the assessment of value is quite tricky. That's why you get people who go, right, I'm going to be a value investor, and they go and buy something because it's cheap, but it actually is cheap for a reason and it never actually rises in value and keeps falling. So value investing is quite tricky to get right.
There's an element of speculation there, right?
Well, yeah, you've got to assess the value is, and that your assessment of value is correct and the rest of the market is wrong. And so in the long term, if you pick up those good value stocks, then they will hopefully revert to mean or rally and you'll make money. Warren Buffett is the most famous person who is a value investor, but you need to do a lot of homework to be a very good value investor. The next one I've been asked about is cyclical stocks. So people say, what's a cyclical stock? And often you see the words value stock and cyclical stocks used quite close together when people are talking about investing. Now, technically, a cyclical stock is one where the company's fortunes are tightly woven with that of the economy. So if you go to 2020, it was a brilliant year for understanding what cyclical sectors were, because anything that was shut down, pretty much because the economy was shut down because of the pandemic, you think about those companies that were shut down, those are the cyclical sectors. Those things that carried on regardless, because even though the economy was crashing around our ears, there were sectors that were continuing. Look at technology, for example. Technology stocks were doing really, really well. Certain sectors, travel was getting hit abysmally. So that was a cyclical sector. There are other examples that are tightly woven with the economic growth as well. So what happens is you often get value and cyclical sectors being quite aligned. In fact, value is often a subset of cyclical, if that makes sense, because if you get an environment like we've got now, what is value? The stocks that offer value are the things that were getting hit probably last year, and so people think they've got a lot of value in them and they'll buy them, and they happen to be the cyclical sectors. Those sectors have started to do quite well now the economy's opening up again. So as you see certain parts of the economy open up, so some parts of retail, maybe dining, then their share price will start to pick up. And of course, they were unloved. They were technically classed as value plays as well as being cyclical. So you can see how they're interwoven. Now, the next one I've been asked about is the reflation trade. So what is the reflation trade? Reflation describes an environment where you've got inflation accelerating, so it's growing, but also economic growth accelerating. So you can understand why, looking at the environment we're in now, so the post-pandemic, the economy starting to open up, we're starting to see both of those things happen. The economy is starting to boom as people are going out and spending money. You just look around you at the weekends, the shops have got people in them again, and people are returning to work in the city and everything like that. So the economy is starting to pick up. People are booking holidays. So we're also in an environment where demand has picked up, but supply of goods and services is actually slightly restricted. Because you think about it last year, when factories probably closed and goods weren't being imported. Now we're at a point where people are wanting all those goods and services. The stockpile of stuff that we have in the UK is now being absorbed, and that's causing a lack of supply, which pushes up prices, and that's inflation. So that's the environment we're in, and that's called a reflationary period.
There's a really good example of that where I live. I live on a new build estate, and they're still building houses. And one of the builders I was chatting to, the foreman of the site, says there's a massive issue now with stock, with the supply, because you had that sort of close down of the period in the lockdowns. They've diminished all the stock that was there. The factories were closed down for so long last year that now there's a massive issue with supply.
So when you say stock, you're talking about raw materials?
Raw materials, yeah.
Like timber and stuff like that. So if you looked at commodity prices, they were going up really quickly at the beginning part of this year. So if you go back to podcast 237, I did a whole piece on these different environments where we look at the two factors about growth and inflation. So you can think about it, you could have inflation accelerating and growth slowing. They're different environments which favor different types of investment. So in the current market, the reflationary period we're in, then anything where you've got exposure to things where interest rates could potentially go up. So that was why financials did really well recently, because if interest rates go up, that's good for financials. Technology stocks initially lagged because this environment isn't necessarily perfect for growth stocks. It goes back to the point I was saying, they don't tend to pay dividends. So you think your payday as an investor is further off in the future, and therefore if interest rates go up, when you discount back an amount of money in the future to today's date, you work out what a future pot of money earnings would be worth in today's money. When the interest rate is higher, today's value is smaller. To allow people to understand that, if you think about, if you put a amount of money in a bank account, £1,000 in a bank account today, if the interest rate is higher, then the amount you get in 20 years' time will be a bigger pot of money. So you work that in reverse. That means that growth stocks start to be less attractive when people think inflation's accelerating, and the central banks like the Bank of England will start putting up interest rates. So you get certain types of investments and assets start to do particularly well. So you get people who, if you go back to podcast 237, I explained it fully there, who look at what environment we're in and work out what type of things they should buy from a very top-down macro view. And if you think about it now, what's going to happen next? The next fear is that growth is starting to slow again, perhaps because of COVID, perhaps because central banks might be forced to raise interest rates, and that will knock off some of the steam out of the recovery. So we could be moving into another economic period. Now, next, bull market. What's a bull market in stocks? Then a bull market is typically associated with a pretty positive economic backdrop, but it doesn't have to be. Often people look at it from a technical perspective, where it's a 20% rally from a recent low. And then you have a bear market, which is where you get a 20% fall from a recent high. So you can get a bull and bear market happening one after the other. And in fact, we saw that last year, where the market fell about 30-40% on most equity markets. That defined a bear market, but then very quickly it rebounded. And therefore, we were still way below where we were at the start of the crash in February, but the market had rebounded 20% and therefore was entering a new bull market. So that bull market started in March the 23rd in 2020. So they're the definitions. I won't go into the reason why they've got animal names. Hawkish and dovish. I talk about hawkish and dovish. That normally refers to central banks and their view on what they're going to do with monetary policy. So that's interest rates. So if someone is hawkish, that means they're thinking about raising interest rates. And normally the reason they do that is because they're worried about the economy overheating and inflation getting away with itself and accelerating too quickly. If they're favouring reducing interest rates, they tend to be called dovish. So it's like a sliding scale, really. You get people in the Monetary Policy Committee, which you have in the UK, Bank of England. They will all be variations of those. So you'll get some people who want to raise interest rates, you get those who want to leave them, and those who want to cut interest rates. And it's a majority vote. So that describes the mood of the people within that committee. Another question I got asked was actually monetary policy and fiscal policy. What's the difference? Fundamentally, monetary policy is what central banks do. So they raise interest rates. They might even do QE. Fiscal policy is what governments tend to do. So, where they look at raising taxes and generating money that way. And in the environment post the financial crisis, we got a bit of both. And that tends to happen, we had it after the pandemic too. And it basically gives you a flood of liquidity. If you have loose monetary policy, that means cutting interest rates, maybe doing QE at the Bank of England. And if we have accommodative fiscal policy, that might mean tax cuts, that might mean support from the government, as we saw, like I say, in the pandemic. That is all money just sloshing into the system, and that therefore tends to be very positive for prices of pretty much everything. I'm talking particularly about things like shares. Risk, I got asked, what is risk? Risk is fundamentally the difference in the outcome of what happens when somebody, say, invests money, so the return they get from what they expected. So that is risk in a very basic level. So people talk about investment risk. You think about cash, you know what you're going to get. You get told an interest rate, assuming the bank doesn't go bust. The risk is very, very low that you won't get your money back or the return you're expecting. As you move up the spectrum from bonds to equities, that varies hugely. As you get to equities, the range of possible returns is quite wide, and so therefore you could end up losing money or you could make more money than you thought. Volatility is something slightly different, and the technical definition of it is that it's a measure of the dispersions of returns that you get from a particular asset. Now, I think keep it simple, just think of it as the wiggly line. Look at the share price on your stock app or the FTSE 100. That wiggly line going up and down, that's volatility. That shows you the amount the market's moving. If there's a lack of volatility, it would just be a straight line. If there's a lot of volatility, you'll see all those peaks and troughs like mountain ranges. Now, volatility isn't a measure of risk as such, because you can see they're two different things from what I've just defined them as. But if you have high levels of volatility, you're going to get a high level of risk, i.e. if the market's going up and down and twitching a lot, then if you then sell your shares, the chances of you getting back less than you thought you would or losing money increases. So volatility is not a direct measure of risk, but they are interwoven. So I am of a view that if something has a high level of volatility, then it does tell you a lot about the potential risks of something. Alpha is another word that people hear bandied about, particularly with fund managers. Go back to podcast 220 where I go through lots of different statistics about funds to look at, including beta. But very simply, alpha's the edge that a manager will give you over the market, or they've had over the market. So it's that extra bit that they've made over the market, their edge. A benchmark. Now, a benchmark is used to give you something to compare performance against if you're looking at investment returns. So you had a fund manager and he's invested in UK equities. He might have the FTSE All Share, which is a broad index, as a benchmark. And so you can see if he outperforms that, he's doing pretty well, because he could have just bought the FTSE All Share if he wanted to replicate UK equities. But if he's done better than the FTSE All Share by buying and selling things that he or she thought were offering great opportunities, then that's the point of having a benchmark. You can judge performance. Overweight, underweight, you'll hear those terms. If somebody's overweight in a particular asset or maybe country, that is again comparing it to a benchmark. So you could say that if a fund was underweight UK equities, then compared to maybe its sector average or the benchmark that the fund chooses, it might hold less UK equities than the rest of them. It might hold less of a particular stock than a lot of them. It could be something like Apple, because obviously most funds will have exposure to Apple somewhere, particularly if they're a North American equity fund or a global equity fund. So you can see it's useful to be able to differentiate funds. You might want something that's underweight or overweight in something because you have a particular view of where you think the world is headed. Gearing and leverage, that's quite simple. That is basically borrowing money to invest. So if you see those terms, if something has high gearing, that means it's borrowing money to invest. Investment trusts can do that. That will amplify the volatility and ultimately the potential risks. Passive investing, that is different to active investing. Active investing is where you pick maybe individual stocks or shares, or a fund manager does, and tries to use their skill to beat the market, say the FTSE 100 or whatever index you choose. Passive investing is where you pick something like a fund that aims to just to replicate and track the wider market. So it just tracks the movement of the FTSE 100. So it's passive because you're along for the ride. You're not doing anything. There's no manager doing anything. And often they're very cheap, much cheaper than active funds. And obviously, as people know who've listened to this podcast long enough, they do tend to outperform most active fund managers. Pound cost averaging is one people ask about. What does it mean? Well, in a falling market, if you drip your money into the market every month, rather than put your £10,000 in at the start, if you put your £10,000 in at the start of a market fall, then by the end of the market fall, you might have a certain number of shares, but the value could have, say, halved. Then you need the market to rally back to where you were before in order to break even. If you invested monthly, so put £1,000 in a month, so that would take you 10 months to put all your money in the market. And as the market's falling, the price of the shares that you're buying each time of your £1,000 is getting cheaper. So you end up buying more shares. So therefore, at the bottom of the market, let's say the market bottom coincided with the 10th month you invested, you would have invested £10,000 in both instances, where you dripped in the monthly or you invested the money at the start. £10,000 would have gone in, but in the dripping in version, you would have actually bought more shares. So when the share price then rallies, you will make more money in the second option. So you start to limit your losses in a falling market. So that's the benefit of pound cost averaging. Put it another way, it's like going into a shop and getting a 2-for-1 deal. Your money's going that bit further, so you benefit in the long term. And the last one I'm going to do before we bring the others on the show, because I realise I've been rambling a bit, is shares, equities and stocks. What's the difference? Because you hear those words a lot when I'm talking. And to be honest, they're interchangeable. So don't worry about it. If you hear the word shares, you hear the word equities, and you hear the word stocks, they're all interchangeable for our purposes.
And what about assets then? Because I hear that interchanged with a lot of those
Yeah,
phrases.
you will do. So a share is you invest and you get a stake in a company. So that's a particular type of asset. So you hear asset or asset classes. And a bond is a different type of asset, so is property. So it describes a type of investment. But within those different classes, you can have the nuances that we talk about sometimes on the podcast. So within the bond space, you've got gilts, you've got corporate bonds. So there are differences, but assets are things like, think of a car, a house, all of those things are assets, things that you can own, and they can all be different, but they all fall under this one umbrella term. So when I say asset prices go up, that means that pretty much most things are going up, because if you own it, it's going to go up. So when I talk about the liquidity, asset prices tend to be going up when you get a flood of liquidity into the economy, because it does start to push up most things. Not everything will necessarily go up, some more than others, but most assets will go up, and that includes house prices.
Okay, so moving on to the next piece then, and we're going to welcome Laura back on the show, who's going to be talking about mortgages and looking at specifically lenders and how much you can borrow, and provide some insight on that.
Yeah. So Laura was on the show on podcast 317 and did a whole piece about mortgages for low deposits, but that was really aimed at first-time buyers. But now we're thinking more widely about the mortgage market for people who maybe are already on the housing market looking to remortgage. So Laura, you'd be looking at how much money you can borrow on a mortgage.
That's right. I think with house prices going up as much as they have over the last year, it's becoming more of a stretch for people either looking to get on the property ladder or, as you say, looking to move. And I think people are trying to work out what the maximum amount is that they can borrow. And the fact is that that has changed over sort of recent years. Lenders are looking at slightly different criteria when they're making that decision.
So how are they assessing affordability?
So whereas in the past they'd simply look at income multiples, so they'd look at your salary and any other income that you had and apply quite a simple calculation on that, typically maybe 3, 4, 5 times your salary. Now they look more carefully at affordability, what you can actually afford to pay on your mortgage. And that takes into account set expenses that you have, so what you're paying on your bills, what you're paying for things like car insurance, home insurance, but it also incorporates some degree of discretionary spending, so what you're spending on things like gym membership, going out to eat, or other sort of recreational activities.
So they're looking at your spending, so they'll be looking at typically your bank statements you'll have to give them. Oddly, you don't tend to have to give them your credit card statement. So if you're somebody who lives on your credit card and then clears it each month, presumably they'll factor in an element of assumptions on about spending for certain people on food, etc. So look at affordability, income, outgoings, and presumably they're doing some form of stress testing at the moment.
That's right. I think that's become more to the fore over recent years. Lenders have got to demonstrate that they are lending responsibly, and that includes incorporating what will happen if interest rates rise substantially. And we've got to remember that 10, 15 years ago, the norm for interest rates was around sort of 5 or 6%. We're now down to record lows, but that is unlikely to last forever. And what they do now is assess it on the basis of interest rates going up by 3%. So rather than being around the 1% that the best rates are at the moment, they're looking at whether you can afford that deal if it goes up to nearer to 4%.
So there's still, when we're now thinking about how much could you borrow, so there is still obviously affordability testing, there is still the general principle of multiples that exist as well. So what sort of multiples are we talking about at the moment?
Yeah, so while they are looking at these other factors, income still is the central consideration and multiples of that income. It tends to be, as a general rule of thumb, you're looking at, say, 4.5 times your income. However, there are some more generous income multiples available from a number of lenders. These tend to be quite targeted at particular groups. So there are a few first-time buyer providers who are offering more generous income multiples. So, for example, Nationwide had their Helping Hands scheme that offered 5.5 times salary for first-time buyers. With that one, though, they were really targeting people looking at longer fixed-term deals. So they're looking at 5 to 10-year fixed-term deals for those first-time buyers to give them, I guess, a sense of stability over that longer-term period. So aside from first-time buyers, there are other lenders who offer so-called professional mortgages. So these are aimed at people who are perhaps newly qualified in certain professions, such as lawyers or doctors or engineers, a profession where their salary is likely to increase over time and likely to increase in a predictable way. So it's very likely that they will be able to afford the mortgage even if interest rates do go up over time. It's worth noting, though, that different lenders have different professions that they include within this. So, as always, you really need to look at the individual terms and conditions for the lenders that you're considering for these products. And as a rule of thumb, you're looking at around 5.5, perhaps even 6 times your income with these lenders for these deals.
Okay, another question on this is, what about joint mortgages? Because obviously in the past there were different multiples that were used for people who were buying a house, say, in their own name versus those who were buying them as a couple.
Yeah, you're right. It tends to be the case now that rather than in the past where you'd get a slightly more generous multiple just as standard if you had a joint application, now it tends to be the case that you get the same multiple applied, but you benefit from the fact that obviously you have 2 salaries combined. You're going to be able to borrow more. And also some of those affordability criteria will be less hard to meet if there's 2 of you contributing to bills and other expenses. So generally, you're going to be able to afford more overall. As a side note to that, for people looking to buy a property with 3 or 4 people, say, if you were buying with friends, lenders tend to only take into consideration the top 2 highest salaries when they're making that calculation. You can't decide just to club together with a group of people and get a very high income multiple.
So the message to that is make sure you have friends who earn more money than you.
Basically,
Go become friends with lawyers and and doctors.
You're sorted.
So the other thing we were talking off pod actually about is that if you earn more money, they almost seem to be a little bit more lenient on some of the affordability. Is that right?
Yeah, you can definitely get some more generous deals if you are lucky enough to be in that higher bracket. So, for example, with Metro Bank, if you're lucky enough to earn over £100,000 a year as a single applicant or 150 joint, then you will be able to borrow 5.5 times your salary, depending on other affordability
So you're
criteria.
looking at north of £500,000 there, but based on those multiples, they're quite generous. For people listening to this, because obviously Laura's given you quite a lot of information here, there is an article we're going to link to on the website. So if you go and find the podcast show on the website, or indeed the show notes of this podcast, we'll link to it so you can actually see the different lenders that Laura's analysed. One last one I thought I'd mention is, or ask you about, is what about self-employed people? What's the deal with them?
So typically lenders tend to be more wary of self-employed borrowers in terms of giving them these higher income multiples. Generally, a lot of these lenders who are offering over 5 times your salary exclude self-employed borrowers. Generally speaking, most lenders are looking for a minimum of 2 or 3 years worth of accounts to prove that income, to prove that affordability.
That's fantastic. As I said, we'll link to the article in the show notes that Laura's written. But the message I want people to take from this podcast as well is the importance of seeking advice when it comes to getting the mortgage. This is from personal experience, and everybody in the office shares the same view, that getting advice for a mortgage makes all the difference, because Laura's mentioned lots of different criteria, eligibility, affordability assessments. A good mortgage broker, so an independent one that has access to the whole of the market, will know straight away which lenders could lend you the most money for your circumstances. And my other bit of advice is start talking to them before you want to go and get a mortgage. So go and talk to the mortgage broker as much as a year before you know the point you think you might want to buy a house, because there's going to be lots of things you need to get into order, especially if you're self-employed, and they can help you do that so you can therefore get the mortgage that you want. And if you don't have a mortgage advisor that you can trust, then you can use sites like vouchedfor.co.uk, which allows you to search mortgage brokers in your area and actually see reviews of them as well.
Okay, so the final piece of the pod then, we're going to welcome Bronte back to the show by popular demand, of course, and we're going to be talking about home insurance. Now, this particular piece of the pod came about from something that happened in the office, didn't it, Bronte? Anyway, Bronte, sorry, welcome to the show. How are you doing?
Hi, I'm good, thanks. Good to be back.
Yeah, great. So this came about, didn't it, from something that actually happened in the office. And that is sometimes the way of what we do at Money to the Masses. And when we come up with new ideas, things just kind of spawn from everyday life, things that happen in our own lives. And actually, something happened to Harvey. Do you want to explain what happened?
Yeah, so essentially, Harvey was working from home recently and happened to look out her window and see that a few doors down, a house that was being renovated, had some major construction work going on, was on fire. And no one was injured, no one was in the house, he shouldn't have been, everyone was okay. But the question arose of whether or not the people who were in that house had insurance to cover the cost of the damage of this fire, because it looked quite serious. The damage was quite extensive.
And that's specifically in relation to the fact that they were having renovations being done at the time, right?
Yeah.
And so you were on it, weren't you? You were pen at the ready. You were like, right, I'm going to do the research and I'm going to get this article written.
Yeah, because we had a discussion just between us in the office, which was, do you have to let your insurer know? Is this like common knowledge that you should let your insurer know if you're having major renovation work done on your property? And the interesting thing that came up was some of us in the office, such as Justin, said that yes, when he had work done on his property, he'd been told that he had to let his insurer know. There's a couple of the rest of us were like, oh, I didn't know that was something you had to do at all. So there was definitely some misinformation and sort of confusion about the topic. So it was just a case of, let's get down to the basics. Let's make sure we explain this and people know what they need to do, what they need to tell their insurer about, or what they don't need to tell their insurer about when their house is being renovated.
Great. So home insurance then. Do you need to tell your insurer if you are doing things like renovations? You're going to run through the details.
Yeah. So it really depends on the type and extent of renovations that are happening. So, for example, if you're just making minor cosmetic changes to your property, like you're painting the walls, you're fitting some cupboards, you don't need to tell your insurer about that because that's an interior design thing. It's not related to the structure of the building itself. So you wouldn't need to tell your insurer if you were just, giving a fresh lick of paint to the living room or whatever. But if you're, for example, roofing, if you're adding an extension, if you're having your loft converted, if you're removing a load-bearing wall, all of these things potentially jeopardize the structure of the building itself, which is the sort of scenario where you would need to tell your insurer.
Great. So there's sort of things that will mean you'd need to get in touch with the insurer. So when you're getting in touch with them, in preparation then, what sort of things do you need to let them know?
Okay, so there's a number of things. One of them being how long you expect the work is going to take to complete, the projected costs, whether you'll be staying in the property, or particularly if you're having quite an extensive renovation, like you're completely changing walls, adding a large extension, whatever, having the loft converted, you might have to move out for a period of time, and that can definitely affect the extent of cover that you'll get. You should also include your builder's details, and this one's really important, whether your builder has their own public liability insurance.
So those last couple of points there were kind of highlighting who the builder is and whether they have their public liability insurance. What about, though, if you're not using a firm? What about if you're competent and confident enough to do the work yourself? Do you still need to do the same process?
Okay, so DIY projects are a bit notorious in terms of being able to claim on your home insurance. So for a small job like redecorating, stuff like that, you wouldn't need to let your insurer know anyway. And you're going to have to inform them if you're making a major change like removing a load-bearing wall. But if you're doing something like you're doing your own plumbing or something, some home insurance will cover minor damage such as, you accidentally put a hole in a pipe and there's a flood. But you'd need to check the details of your cover to see that that is definitely assured that you will be covered for that. But if you're doing a major project on your own and you're not actually qualified to do the work in the first place, you're probably not going to get cover and you're probably going to have to pay out of your own pocket. So if you are planning on undertaking quite a large project all by yourself, it's generally recommended that you get a self-build insurance policy, which basically just covers for major structural damage, not just to the building, but to yourself that might happen if you're, undertaking a project all on your own. But generally speaking, if you're just doing easy DIY like painting, you'll probably be all right.
Okay, so that self-build insurance policy is like an extra little policy that you would take out for the period of that project just to cover you for that. And then that policy would then probably cease or...
Yes, as part of applying for it, you would let them know the length of time that you would like the cover for, yeah.
So let's assume there's people out there who are thinking about making alterations to their home. What sort of things can they do to sort of maximise their home insurance, guarantee that they're going to be covered for this?
Okay, so there's a number of different options spanning from being suitable for the least amount of work on your building to the most, and whether or not you're conducting the work yourself or if you're hiring someone externally to do it for you. So the first one is accidental damage cover. So Sometimes this is included in a home insurance package, but most times it's sold as an optional extra, which you would have to pay extra for. So do check the T's and C's of your contract. But essentially, accidental damage cover just offers a fallback for minor damage sustained as a result of accidents during construction. So, for example, if you're moving a unit into the house and a window gets smashed, or a door gets ripped off its hinges or something, quite minor issues and damage, you might be able to recoup some of the costs associated with fixing or replacing items that were damaged in the process. But the important thing is it wouldn't cover you for significant structural damage. So, for example, if a wall collapses, if there's a fire or something like that, accidental damage cover probably wouldn't pay out. But it would cover you for, like I said, broken glass, broken doors, damaged baths, pedestals, sinks, toilets, broken septic tanks and wires, and broken locks and keys. So overall, relatively minor things. So that's definitely something to consider if maybe you're having workmen in and out of the property, but you're not too worried about the structure of the building being jeopardized. Another one is specialist renovation insurance. So this one is most suitable for people undergoing large, extensive construction on their property, and this covers you for quite a wide range of scenarios. So policies can range from insurer to insurer, but quite often it would cover things like damage to or loss of possessions in your home while you're having the construction done. So even if something is stolen during construction, some of these policies will pay out to cover the costs. It can also help with public liability cover in case of accidents, not just to yourself, but to others on the building site, and also accidental damage as well. So for example, something gets spilt on a carpet or a window is broken, just like in the accidental damage cover. So this one is best suited for those. There's a lot more happening on their property, and it will cover far more scenarios than the accidental damage cover would. But as always, make sure you read the T's and C's of every policy that you're looking at, because each company will have their own range of things that they cover and don't. So it's better to be safe than sorry, and just make sure you read all the small print. And the last one is self-billed home insurance. So this one is specifically for people who are undertaking construction and doing it themselves. So it's essentially very similar to specialist renovation insurance, except that it's just if you're doing it yourself. It would cover you for the same kind of scenarios that you might expect to happen with other people working on the site. But if it's just you, it will cover you for the potential damage to your property, but also to yourself. But all in all, you should always, if you're having a builder and external people come in and work on your property, you should make sure that they are insured themselves. So most professionals should and probably do have their own insurance to cover the work they're conducting anyway. And it will also usually cover any damage sustained to your neighbours' properties too. So if you're, for example, having work done on an adjoining wall on a terraced house, if there's any damage sustained to your neighbour, it should cover you for that. So the easiest way to do that is basically just ask your builder, make sure you see a copy of a valid insurance certificate. And it's really important to check that that doesn't expire during the course of the project, so you save yourself some legal issues there. And a good idea is to take a copy, maybe take a photo on your mobile so you can refer back to it at any time. But just always make sure if you're having someone come in to work on your property that they are insured themselves as well. Overall, if you're having any work done on your property, whether you're undertaking it yourself or not, just contact your insurer. Make sure that if there's anything you're unsure about, make sure you get it ironed out about whether your contract covers it or not.
Great. So thanks again for coming on, Bronte. That was really interesting. And like I say, that was spawned from something that happened personally to Harvey's neighbour, and obviously simply goes out to them, and hopefully everything can be sorted. And so that's it for this week. So if you want to get in touch with Damien, you can do so in the usual way. It's Damien at moneytothemasses.com. Twitter, it's at moneytothemasses with the number 2. We've got the Facebook group as always, and YouTube if you want to check out any of our videos. Lauren's been putting lots and lots up on YouTube lately. And of course, if you can review the podcast in whatever way you download the podcast, it would really help us out. And so, Damien, that's it. We're done for this week. And until next time.
Yeah, so that's it. Until next time.